Despite a solid employment report in the USA and Wall Street finishing at a high for 2016, the Australian share market limped along today to close almost unchanged. However, it's still only up 60% on its post-GFC low from March 2009, compared to almost 297% for the US markets. To discuss why the Australian market continues to underperform and what this might mean and what might change it, I'm joined by Martin Lakos, the Division Director at Macquarie Private Wealth. Martin, welcome to the program.
Thanks, Paul. Good to see you.
Let's start with the US data. It was pretty good data. We had employment of 215,000. I mean, what was your take on the data that came out of the States?
Yeah, not really a surprise, given the independent ADP data was saying about 200,000, and we've been seeing very consistently that employment growth continues on its merry way in the US, and that's certainly one of a number of factors why the US Central Bank is considering raising rates later this year, and it looks like they're bound to do that. The underlying growth of employment is around about 170 to 180,000 jobs, so 200,000 is a great number, really, and it's been very consistently around those levels. So it does show the structure of how the US economy is going. It's coming from consumer spending, it's coming from the construction side, and of course the Americans have always been very canny in reinventing themselves. So post GFC, you know, they've innovated, and certainly the IT sector has been one of the big areas that has helped the US economy improve productivity, for example. So
does this data bring us any closer to the next rate rise? I mean, there was talk about April. I think the market would sort of push it back to June. I mean, what's your take
look,
on that?
It does look like Janet Yellen is being spooked by the markets a little bit. You know, if you remember at the beginning of the year, there was almost you know, some belief that we would see up to as many as 4 interest rate rises this year, but the January-February volatility in global markets, concerns about global growth generally, which now appear not to have really come through, or those concerns, in terms of the real economy, she's put things on hold. But and most analysts, including our own, have now pulled back, thinking sort of 2 to 3 rate rises this year. But we think that's still happening. Underlying inflation is starting to pick up, which is good news, and the economy's still got plenty of room to move. So in the construction space, particularly in residential, to give an example, Paul, the long-term average number of houses built in the US is about 1.5 million houses. We're currently seeing about 1.1, 1.2 million. So in other words, potentially still another 200,000 or 300,000 houses yet to be built just to meet the long-term averages. So plenty of activity in that area.
So we got this good lead out of the US. Why didn't it translate to a bit more of a better performance in our Australian market? I think we finished down 4.5 points.
Yeah, very disappointing. We were up 46 and didn't follow through. The banks again, which had rallied, it came off. The energy materials space today, you know, underperformed, and even the stocks like Telstra, which is up to 533, couldn't hold its gains to 527. Now, what we have been seeing in the last couple of weeks is some interesting activity in the futures market, which is certainly suggesting, and when I say interesting, I'm talking about higher volumes, particularly last week, that might indicate that we're still seeing some selling from offshore. Now, whether that's currency related, it's hard to gauge. But certainly,
it's hard to see that in the currency. I mean, the Aussie dollar, 76.5 cents today, it still looks pretty buoyant. I mean, if they're selling from offshore, it's not showing up in the...
Not yet, but maybe they're selling dollar assets rather than selling the currency straight up. But maybe they're taking the view the Aussie dollar has more downside and don't want to necessarily be long Australian dollar assets. The other side is that the makeup of our share market is actually quite different to the makeup of the US market in terms of the total sectors and what the value of those sectors are. You know, we're dominated by our banks, 29% of our ASX 200 index. Now 13% of the index was resources. Now it was a lot higher, obviously, before, same with energy. But you can account for about 4 key sectors, including Telstra, accounts for over 53% of our market. Whereas the US is a much bigger finance sector, much bigger IT sector that's driving their market, and that's where the huge outperformance of the US market has come from, and you know, it really shows up the underperformance of our market.
We talked about the intro. I mean, 297% for the US market since I think it's somewhere in March 2009 versus 60% for the Australian market.
Sure.
Is it just the mix of our market? I mean, or is it we just we don't have companies that know how to grow. Why has the US market done so much better than the Australian market?
Well, you've also got to look at the economy, and the US economy has done so much better than ours, really, post-GFC. A rebound from a very low base. Obviously, things were pretty dire, whereas our economy's actually gone the other way. You know, we were growing at nearly 4% at the peak of the mining investment boom, and we troughed out around 2%. So the growth momentum in our economy has slowing, and with that, earnings growth in corporate Australia has been slowing as well, whereas you've seen the complete reverse in the US. I think we're now up to nearly the 5th consecutive year of pretty strong corporate profitability. And now that's not going to last forever, but that's been really one of the reasons for the drive in outperformance.
What could be some catalysts to get our market going? I mean, is it commodity prices, oil prices need to stabilise? You know, when you see some better earnings, or when the banks, people have to stop worrying about credit losses in the banks? What could...
All of that.
All of that?
You virtually answered the question. Look, I think the other side of it is confidence. Now, when you look at where we've seen one of the big gaps is the US has seen a real resurgence in business investment taking place, whereas in Australia, that's really one of the key areas that's truly lacking. Now, it's not that we don't have the capacity to invest. Australian balance sheets of companies are actually in pretty good shape, as you know, but we haven't had that confidence to invest.
So they're the glass half full guys and we're the glass half empty guys,
Sure, I think that's probably right, yeah. But we are looking, I mean, Macquarie's view is that we might see a better market second half of this year. Our strategist, Jason Todd, is certainly looking for a total shareholder return of around about 15% from this point on. So that's roughly capital of around 10%, capital growth, and about 5% dividend growth.
Well, let's hope he's right. You've also, I think, got a little more positive about the banks. Is that correct, Martin?
Yeah, our latest piece Jason put out, he's now gone overweight the banks, largely because, again, we just think that what's been going on in the marketplace in terms of impairments and concerns on balance sheets, they're real concerns, but are overdone. And the valuations are starting to show up. I mean, we've now got the banks on 11.5, 12 times earnings. The rest of the market is on 14.5 to 15 times. Dividend yields, we think, are intact. The impairment side is not going to impair earnings. That's going to exceed dividends.
And, you know, ANZ now yielding more than 11% on a grossed-up basis. I mean, there's been some talk maybe about a small dividend cut. Use your Macquarie's view, think the banks can continue the dividends where they are at the current levels?
Yeah, it's more likely rather than cuts. It's more likely to see dividends remaining static for a while. And we're going to see those payout ratios, that's the amount of earnings that gets paid out in dividends, holding around 70 to 75%. And we've tested that in our models, and we're reasonably comfortable with that given where we think impairments currently are. So, you know, the answer is yeah, we think dividends are intact.
The Reserve Bank tomorrow meets, I believe it's down in Tasmania. Any chance of a rate hike?
Can't see it this time around for a couple of reasons. You know, the last set of data really showed the Australian economy looks reasonably stable. Not shooting the lights out by any stretch of the imagination, but the GDP data with 3%, unemployment dropping to 5.8, inflation at 1.7. You know, these are not disaster numbers that would warrant a cut. The caveat here, Paul, might be the currency. We've got to see where the currency goes, and if it continues to go up, that might give the Reserve Bank cause to cut.
Is there a level you think would sort of, won't say panic, but whether the Reserve Bank gets pretty serious about cutting?
We certainly think if it goes towards 80 and is sustained around that 80 level, that might give the cause for the Reserve Bank to cut. But there's a couple of things coming up. And certainly there won't be a cut next Tuesday, is our view, simply because there's two key pieces of data coming out later in April. That's unemployment and inflation. And it's the inflation data that's very important to the Reserve Bank to see where inflation is currently tracking. That's on the 20th of April is my understanding. So the earliest we would see a potential cut is May.
OK, Martin, on that note, thank you for that. We'll look forward to keep close track of that data. Thank you for joining us on Switzer.
Thanks, Paul.
After the break, we'll find out what we can expect from the government's media reforms when Harold Mitchell joins me at the desk. Stay with us.